If you want to understand where the economy is headed, do not watch stock markets, watch credit. Because recessions don't begin with crashing equities. They begin when credit tightens quietly and then suddenly. And right now, something is tightening, not on television, not in political speeches, but inside the plumbing of the financial system. And the people who understand that are not panicking. They're hoarding cash. The smartest man in the room is sitting on cash. Let's start with the most famous example, Berkshire Hathaway, run by Warren Buffett. For decades, Buffett has been the model of disciplined capital allocation. And when markets are euphoric, he gets cautious. And when markets panic, he deploys. As of late 2025, Berkshire was sitting on roughly $380 billion with the B in cash and short-term treasury bills, the largest cash pile in its history. It's not a rounding error and it's not an accident. That's roughly 1/3 of Berkshire's total assets sitting in liquid instruments. Think about that. The most respected investor in modern history is holding hundreds of billions of dollars in dry powder. He's not chasing hype. He's not buying every dip. He's waiting because he understands something retail investors forget. Cash is not dead money. Cash is a call option on panic. And now let's look at credit. Here's where things get super interesting. In February 2026, right now, something happened in the private credit markets that most Americans have never heard about, and you certainly didn't see on CNBC, Fox Business, Bloomberg, or anywhere else mainstream. Blue Owl Capital, one of the largest private credit managers in the world with more than $300 billion in assets under management, effectively restricted redemptions in one of its retail-focused private credit vehicles. So translation, investors wanted their money back and the fund could not meet all of those redemptions without selling assets. So it halted, severely limited withdrawals and began selling billions in loans. This is not a headline you see during stable times. This is what happened when liquidity tightens. Private credit has exploded over the past decade. Trillions of dollars moved out of traditional banks and into private lenders. Loans to middle market companies, floating rate, higher yield, less transparency. And when rates rise, those borrowers feel it immediately. Interest expenses jump. Cash flow compresses. Refinancing becomes harder. When a major private credit firm restricts redemptions, it tells you one thing: liquidity is no longer abundant. And when liquidity dries up in credit markets, equities usually follow. This is how it always starts, and let's look in the past. 2000, dot-com crash. 2008, housing and structured credit collapse. 2020, liquidity freeze before the Fed intervened. And in each case, credit stress came first. Equities reacted later. The next recession won't begin with the dramatic television moment. It will begin with funds restricting redemptions, borrowers missing payments, refinancing markets tightening, spreads widening quietly, and insiders positioning for that possibility. Sound familiar? It should. The simple math of recessions. Let's talk numbers. Imagine you have $500,000 fully invested, say in a 401k. Market falls 40%. Now you have $300,000. To get back to $500,000, you need a 67% gain. That is brutal math. Now imagine instead you entered the downturn with 40% cash. You've got $300,000 invested and $200,000 liquid. Markets fall 40%. Your invested portion drops to $180,000. So now you deploy $200,000 at a 40% lower price. If markets eventually recover to prior highs, as they historically always have, your portfolio doesn't just break even, it compounds dramatically higher. That's not ideology, it's just simple math. It's why insiders hoard cash before the storm. Berkshire isn't alone. Major corporations like Alphabet, Microsoft, and others maintain tens of billions in cash reserves. Why is that? Because when credit tightens, acquisition opportunities explode. Competitors weaken. Valuations collapse. Distressed sellers appear. Liquidity becomes power. Meanwhile, over-leveraged players scramble to survive. The wealthy don't avoid recessions. They prepare for and exploit them. The wealth transfer mechanism. Here's what most people misunderstand. Recessions are not random acts of nature. They are balance sheet resets. Too much leverage builds up during expansions. Cheap money encourages risk. Then rates rise. And then credits tighten. Weak balance sheets fail. Assets reprice downwards. And wealth transfers from those who need constant liquidity to those who provided it. Get the picture? When Blue Owl restricts redemptions, that's not just a private fund issue. It's a signal, and a big one. When Berkshire holds $380 billion in cash, that's not laziness at all. It's preparation. So what do you do now? What do I do now? What do we do now? How do you become wealthy during the next recession? Not by predicting the exact month, not by doom-scrolling headlines, but by positioning. Build liquidity. Even 20 to 40% cash dramatically changes your flexibility. Reduce leverage. No margin, no fragile balance sheet. Identify high-quality assets. And now, companies with strong cash flow, low debt, real pricing power, real profitability. And when they drop 30 to 50%, when the baby goes out with the bathwater, you buy decisively. Detach emotionally. Volatility is not the enemy. It's the mechanism of opportunity. The final reality. Credit is tightening. Private funds are restricting withdrawals. The most famous investor alive is holding cash at record levels. And these are not coincidences. They are signals. The next recession will scare millions of people. Headlines will predict collapse. Markets will drop faster than feels rational. And in that moment, there will be two types of investors. First, those forced to sell. Second, those ready to buy. Which one will you be? The difference won't be intelligence. It won't be politics. It will be liquidity. Recessions do not deploy wealth. They redistribute it. The question is simple. When panic hits, will you be the one selling, or will you be the one holding cash? Thank you for watching all the way to the end. As always, take care of yourselves and each other, and build that stack!